Hello everyone, Professor Christensen here. Today we're going to take a look at the three different cost flow assumptions that we use to account for inventory. FIFO, LIFO, and average cost. So on your screen you'll see a typical kind of problem that you'll encounter in an accounting class where we have Finn's Fish Supplies. He's taking a look at his inventory for one of his custom jigs, which is a lure, and the lure sells for $25. And then up here, not below, is the activity for this period of time. So it looks like it's from January until June 30th, because they're preparing financial statements as of June 30th, and they use periodic inventory system. So remember, periodic inventory system means that they only change their inventory records at the end of a period. They don't do it every time they have a purchase or a sale. All right, so we want to calculate our ending inventory and our cost of goods sold. Once you get better at it, it's easier to do the ending inventory first, because usually there are less calculations with ending inventory. But I'm going to do cost of goods sold first because I think it's a better example of how the costs flow, right? So let's start here. So we have FIFO, okay? So FIFO means the first goods to come in are the first ones to be sold, all right? And then we're going to do LIFO, and then we're going to do average cost. All right, so let's look up here for a second before we start. Let's first find the totals here. So I'm going to find the total number of units available, how many we started with and how many we bought. And then I'm going to find the total cost of goods available for sale, which is the total beginning inventory in dollars, plus everything that we bought during the period. All right, so excuse me, we had 2,750 units. The total cost was $40,917.50. Now, let's also, I like to have just do this little analysis before you start the problem so that you know where you stand. Now, how many units did we sell? Well, we had 2,750 available, and we ended up with 800. So we must have sold 2,750 minus 800, right? So we sold 1,950 units. All right, I think it's helpful to know how many units you had available, cost of goods available for sale, ending inventory, and units sold before you even start your calculations, okay? All right, so now let's go up here. We're going to use the same format here: units, cost per unit, and total cost. So the cost of goods sold, remember, the first ones to come in are the first ones to go out. We sold 1,950 units. All right, so that means over here, this total has to come out to 1,950 units. All right, so the first thing we sold, the first ones to come in are the first ones to be sold. So these are the first ones that we sold, right? So we sold our 1,000 at $14.58, our beginning inventory we sold. All right, what else did we sell? Well, remember, we have to get up to 1,950. So we sold these 500, and those we bought for $15. Okay. And then, so now you could do it in your head, right? We had 1,500 and we know that we sold 1,950. So we know this number is going to be 450, but let me make sure that you know how we got that number. So the number is equal to the total that we sold minus how many we've accounted for so far. Now, why did we have to do that? The reason we did that is because when you sell 1,000 and you sell 500, if you go to the next layer and we say we sold 750, well, we're going to be over the number of units that we sold, right? So we sold 1,000, we sold 500, and now we sold another 450 from this layer here. Okay, so this is equal to the 450 were from here. And let's just carry our calculation down. All right, so now let's add up everything that we sold, 1,950 units, and our total cost of goods sold comes out to $28,852.50. Okay. All right, let me put an underline there so we know that we added up. Okay. All right, so now what's left? what's left in our ending inventory? Okay, so what's left in our ending inventory is what we didn't sell, right? So our ending inventory is equal to this 750 that we bought minus, excuse me, the ones we sold. So there's 300 of those left. And remember, that's at 1505. Okay, and then this whole layer is left, right? This 500, we didn't sell any of those. Whoops, hold on. And go backwards there. I put the equals in the wrong place. Okay, this is equal to that. This is equal to that, and then we'll carry this down. All right, so the total we sold is 800, which is correct, so we're happy about that. And then our total cost of goods, I'm sorry, our total ending inventory in dollars is $12,065. Now, let's just highlight. So we know that the total sold, total ending inventory is equal to total ending inventory, right? And the total sold, let's make those a different color, is equal to the total sold. All right? Okay, now, how do we check? Well, we know that our cost of goods sold and our ending inventory have to add up to cost of goods available for sale. So we're going to add those two together. Okay? And the other way to do that is, let's do another check over here. And you can do this for LIFO also. Take your cost of goods available for sale. That's equal to the 40,000 minus ending inventory gives you cost of goods sold. Okay, so again, these two numbers are the same, and these two add up to our cost of goods available for sale. Your ending inventory and your cost of goods sold are always going to add up to cost of goods sold. Okay, it's cost of goods available for sale. Let me say that again. Your ending inventory and your cost of goods sold will always add back to your cost of goods available for sale. All right, cost of goods available for sale doesn't change because that's the amount that you had plus what you bought. All right, now let's take a look at LIFO. LIFO means the last ones to be purchased were the first ones to be sold. Now, remember, this is a cost flow assumption. That can't happen, right? You can't sell stuff in May. You can't sell stuff from May back in January, right? You just can't do that because you haven't bought the stuff yet. So it's a cost flow assumption. It has nothing to do with the actual movement of the goods. All right, so now the last ones to come in are the first ones to be sold. So our cost of goods sold here, the last ones to come in are these, right? So we sold the 500 at $15.10. Remember, we have to add up to $19.50. We sold the 750 at $15.05. So that gives us $12.50. So we also sold this $500, this layer of 500 units. Oops, hold on, let me see what I did here. So this is equal to that. Just carry that down. All right, so now we could just take a quick look. We know just by adding these that we have $17.50, and we know that we're going to have to make a subtraction here because we only have one layer left, so we must have sold some of those. So what we sold here is equal to the total units sold minus how many we already sold. So minus the 500, minus the 750, minus the 500. So another 200. Now let's add these up. We want to make sure that's equal to 1950. Again, 1950. Okay? All right, so we sold 200 units from our beginning inventory. So now our total cost of goods sold for LIFO, $29,253.50. Now, when prices are going up, this number will always be greater than this number. LIFO cost of goods sold will always be greater than FIFO. Why? Because we're putting the newer numbers into our cost of goods sold, right? We sold the newer units, which were more costly than the older units, okay? All right, so now what do we have left in our ending inventory? Well, we have 1,000 of those minus the ones we sold. We have the 800 left, and they're all at $14.58. Multiply those out, and we get our ending inventory. Okay. All right, so again, let's do the check. So our cost of goods sold plus our ending inventory has to equal back to this number here. Let's make that a different color. Let's make it green. Okay, so those are all the same numbers. Cost of goods available for sale does not change. Again, we could do the same thing we did here. Cost of goods available for sale minus ending inventory equals cost of goods sold. And that works, right? Here's the cost of goods sold. Okay, so let's do our last method, which is average cost. Now, average cost is a little different because every unit carries the same cost, whereas here each unit has a unique cost, right? Has the cost that you bought it for. So to find your weighted average cost per unit, you take your cost of goods available for sale and you divide it by how many units you had available. Oops, that didn't work. So it equals cost of goods available for sale divided by how many units you had available. All right, so $14.88. Now, you can just check that and make sure that it makes sense. So here are all the prices we bought our inventory for. $14.88 looks about right, right? It should be between $14.58 and $15.10. Okay, so now our cost of goods sold is simply the number of units we sold, 1950, times our unit cost. We use the same unit cost for each item. Okay, so this is equal to this times that. So that's it. Our cost of goods sold is $29,014. And by the way, this is going to be between these two numbers. Okay, that's going to be between. So this is always going to be the highest. By the way, this will be the lowest. Okay, this will be the highest. This will be the lowest of all three, and this is going to be the middle. And the ending inventory will also be the middle. Okay? All right, so our ending inventory, how many units do we have in ending inventory? 800 units. Again, the cost is $14.88. So our ending inventory is 800 times $14.88. Let's check again to make sure. So we're going to take our cost of goods sold, add our ending inventory, and we get the same number. Okay, our cost of goods available for sale. Okay, so I hope that helps you with LIFO and FIFO and average cost. Happy accounting, and I'll see you next time. If you like the video, please subscribe to my channel.